Hello and welcome to Morningstar. I'm Emma Wall and I'm joined today by Lewis Grant, manager of the Hermes Global Equity Fund, to give his 3 stock picks. Hi Lewis.
Hi.
So what's the first stock today?
The first company is Dong Energy, which is a Danish utility company. Now, as investors with a real focus on sustainability, this might seem a slightly odd choice, because Dong Energy has got a very large oil and gas business, they have coal power plants, they have a distribution network in Denmark, and they also have offshore wind farms, which of course is why it's interesting to us. But more than that, the management at Dong Energy really understand the threats of climate change, and they're looking to divest the oil and gas business. They're converting coal power plants into biomass, and they're focusing on those offshore wind farms. And actually over the next few years, by 2020, they're looking to double the capacity of wind farms that they have. So this is a real transformation story. It's a very well-run company that understand the bigger picture, and it gives investors the opportunity to participate in this transition in a company that's actually got a depressed multiple because of these legacy businesses, the oil and gas and the coal assets.
That's very punchy, it's very brave and it's very innovative of management. But it's a transferable skill set, because if you're great at running a traditional energy company, are you necessarily great at running a transformation company?
That's a really good question, but when you actually look at what management are doing, they've been doing this for a while. These wind farms are not new. These are not people who've been running coal plants that are suddenly trying to transform. They've taken 5 old Danish companies and merged them together to form this new entity that is part of this clean energy transformation.
And what's the second stock today?
So the second stock is Delta Airlines. So it's a US airline, it's one of the largest airlines in the world, and obviously airlines have had a fairly tough time in recent years. We've had falling airfares, we've had rising wages, the oil price falling was obviously very good for them, but now that's coming back, so fuel costs are going up. But actually, if you look at the results of the US election, we see Trump coming in with some very pro-growth strategies. Some of these airlines with the US exposure look quite attractive. Now, one of the pushbacks we often have on Delta is, how can you be looking at a company in the airline space, given that you're so focused on ESG? And what we often see in ESG is that companies who want to improve first fix their corporate governance. Well, Delta have got absolute leading management. They've got the best standards for corporate governance of all of the airlines in the US. And we've seen already that once they've improved that governance, they've started to look at their social impact, and they've founded a number of programs against human trafficking. Now, what we're expecting to see now is that they're going to look at their older fleet, they're going to start to modernise, start to improve their environmental performance. Because it's not always about finding today's sustainable companies, but it's about finding those companies that can thrive in tomorrow's sustainable world. And looking again for that power of change as Delta improve their environmental performance, that's very powerful. And at the same time, you're getting a company that's got a very solid balance sheet, very good cash flow generation, and looks very cheap.
So they've got the S and the G and now they're just going for the E.
That's absolutely right.
And what's the third stock today?
The third stock is Ingredient, who are an ingredient solutions company. It's a very grand title, but essentially they make starches and sugars, sweeteners, that go into, well, all foodstuffs and a number of different products. So when you have a yogurt that's very creamy, it's the emulsifiers from a company like Ingredient. When a company is making a milk drink, they often substitute some of the milk with thickeners based off the starches that Ingredient make, because that allows them to increase margins by using less milk. Where this is interesting, though, is on the sweetness side, because another social trend we have is towards obesity, and it's something we need to try and solve, and it's led to a real move towards healthy eating. It's companies like Ingredients that are making the sweeteners that allow us to take sugar out of these foods. So that healthy eating drive means that very high quality companies like Ingredient can thrive. Now, I say it's high quality, it is a quality growth name that's done very, very well for a couple of years, and some of these companies are overvalued. You are paying a premium for this company. But actually in the second half of 2016, it's pulled back a little bit. So it's an opportunity for long-term investors to buy this high-quality company that's exposed to long-term trends at a much more attractive valuation.
Of course, they're not the only company out there that have been maybe traditionally a sugar company moving into a sweetener company. We know that's what Tate & Lyle are doing quite well. How does a competitor like that play in the market?
So Ingredient is slightly more diversified because they do have the starch business as well. They are US-based and they have a real global footprint, which makes them quite attractive. They're also still achieving superb growth rates, which makes a real difference.
Lewis, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.